Hey there, fellow investors, listen up. Picking stocks isn't about magic, it's about understanding the game. And the game is all about numbers. But hold on, don't get scared off. We're not talking about complex equations here, we're talking about financial ratios. Think of them as cheat codes to understanding a company's story. These ratios help us answer key questions. Is this company making money? How much debt are they carrying? Is the stock price a steal or a rip-off? Ratios give us clues. They help us compare different companies. They help us see trends over time. But remember, ratios are just one piece of the puzzle. Don't get blinded by the numbers alone. Context is king. A good ratio in one industry might be terrible in another. A high ratio might signal growth, or it might signal trouble brewing. That's why we need to dig deeper. We need to understand the story behind the numbers. We need to compare apples to apples, and that's what we're going to do right now. Get ready to decode the language of finance. All right, let's talk profit. At the end of the day, that's what we care about, right? We want companies that make money, and lots of it. That's where profitability ratios come in. They tell us how good a company is at turning sales into actual profit. One key ratio is the operating profit margin. This tells us how much profit a company makes for every dollar of sales. A higher margin usually means the company is running a tight ship. They're keeping costs under control. Then there's the net profit margin. This is the bottom line, baby. It tells us how much profit the company keeps for every dollar of sales after paying all its expenses. A rising net profit margin is a beautiful thing to see. It means the company is becoming more efficient. Now let's talk about debt. Every company uses debt to some extent. It's like taking out a loan to grow your business, but too much debt can be dangerous. It's like walking a tightrope. One wrong step and splat! That's where leverage ratios come in. They help us understand how much debt a company is using and whether it's sustainable. One important ratio is the debt-to-equity ratio. This tells us how much debt a company is using relative to its equity, which is the money shareholders have invested. A high debt-to-equity ratio can be a red flag. It might mean the company is taking on too much risk. Another key ratio is the interest coverage ratio. This tells us how easily a company can pay the interest on its debt. A low interest coverage ratio is a warning sign. It means the company might struggle to make its interest payments if profits take a hit. Remember, debt isn't always a bad thing. Used wisely, it can help companies grow faster, but it's like using dynamite. You've got to be careful. Section 4, valuation. Is the price right? We've looked at profitability and leverage. Now, let's figure out if a stock is a good deal. Valuation ratios help us compare a stock's price to its earnings, sales, or assets. The price-to-earnings ratio, or PE ratio, is the most popular. It shows how much investors pay for each dollar of earnings. A high PE ratio might mean high expectations or overvaluation. The price-to-book value ratio, or PBV ratio, compares stock price to book value. A low PBV ratio might mean undervaluation or issues with the company. Valuation is all about context. High-growth companies usually have higher PE ratios due to future growth potential. Section 5, the perils of blind valuation. Now, before you go out and buy every stock with a low PE ratio, let's talk about the limitations of valuation ratios. They can be misleading, especially for companies that are growing rapidly or experiencing temporary setbacks. For example, a high-growth company might have a sky-high PE ratio because its earnings are still small. But as its earnings grow, its PE ratio should come down, making it look like a bargain. On the other hand, a company going through a rough patch might have a low PE ratio because its earnings are depressed. But as its earnings recover, its PE ratio should rise. The point is, don't blindly follow valuation ratios. Use them as a starting point for your research. Dig deeper into the company's financials, understand its industry and its competitive landscape, and don't be afraid to pay a premium for quality. Section 6, the big picture, ratios in context. So there you have it. We've covered a lot of ground today. We've talked about profitability ratios, leverage ratios, and valuation ratios. We've learned how to use them to analyze companies and make smarter investment decisions. But remember, financial ratios are just one tool in your investor toolbox. They're most effective when used in combination with other tools like Industry knowledge, company research and common sense. Don't be afraid to get your hands dirty. Read annual reports, follow industry trends, and most importantly, be patient. Rome wasn't built in a day, and neither are successful investment portfolios. So keep learning, keep analyzing, and keep investing.